Hey Internet, it's RJ. Welcome back. Thanks for tuning into the show today. Now, today's episode, we are talking about how buying or refinancing a house plays well or sometimes does not play well with credit cards. So we're going to go through it, talk about, all the things you can and can't pay with a credit card when it comes to the mortgage process or buying or refinancing a home, as well as some things that you can and some best practices that you need to be aware of. So if that sounds interesting to you, then go ahead, press the subscribe button, and let's get to work. Now, to start out here, we're taping this probably mid to late March, and that is because this is what's known as in mortgage banking as purchase season. Purchase season is kind of from spring, maybe through mid to late September. Basically, it's getting warmer out. No one likes to look at houses when it's cold and snowing. People are out of school for your kids and things like that. It's easier to move, that whole thing. Now, on the other side, you also have it's not really called credit card season, but this is times when we see the most competitive credit card offers for the same exact reasons. So a well-trained follower of the channel would say, hey, look, mortgage expensive, credit card requires spend. Let me put these two together, maximize my rewards. But it's not quite that easy, though that is how you should be thinking about it. So good for you. You've come to the right place. So what we're going to do is just go through some general questions that I get about this, kind of add some answers, tell you what you can and can't do and some things you need to look out for. So the first thing, the biggest question I always get is, can I buy a house with a credit card? The answer is no. The short answer is no. There's a few reasons for this, but it has to be certified funds, right? That's why when you're going through the mortgage process, the bank asks you for documentation, bank statements to prove you have that much money for the down payment and, for future payments. You can't just use all your money on the house and then have no money. Even if you have cash, right, it's still, they want to see it in the bank because it's a lot of it's the know your customer rules and things like that the government puts in place. Now, the other part is that, if you bring it's certified funds because when you come to the table, you're giving that person a check, they're giving you the keys, and then after that, they're gone. So if you have a certified check, from your bank, then everyone knows that check is basically good. That money is there and it's going to cash. Sometimes you can also do a wire as well. If it's a little bit amount of money for closing, few thousand maybe, depending on the bank, you may be able to write a personal check, but I would bank on certified check, from getting it in branch or a wire, something like that. Now, to that point, or closely associated to it, can you make your monthly mortgage payment with a credit card? Well, kind of. There used to be ways to do it, but it's getting increasingly harder. So making your mortgage payment direct to the bank or the mortgage servicer, no, they don't take credit card. And there's a few reasons. So number one is when you're trying to pay debt with other debt, the mortgage loan with the credit card loan, that person receiving it, the mortgage company in this case, doesn't really know if the following month you're going to have to make a decision on, do you pay them next month or do you pay Bank of America back? So that's number one, they require an ACH. Number two is the cost. There's nothing physically stopping you from paying with a credit card other than that they're not set up for it on purpose, right? There's that 3% processing fee that everyone charges for a credit card. So why not just charge 3% to people and let them pay with a credit card? I'm sure you can probably find someone out there who does this, but this is very uncommon. And the reason being is, this will be more of a lesson on mortgages. When you have a loan, you close a loan, that loan is sold, right? It's usually Freddie Mae, Fannie, somebody like that. But there's someone that still needs to collect the payments and make sure your homeowner's insurance, your taxes are paid up on time. Because the only thing that can, outdo the mortgage company is Uncle Sam. If you don't pay your taxes or homeowner's insurance, the thing burns down, that will, undo what the bank has. They'll take precedence. So you need someone to make sure you're paying all of those things. That's where mortgage servicing comes into play. And you can sell the loan and you can either sell MSR. MSR stands for mortgage servicing rights. And so a company will come in and they'll service that loan, do all that requirement. And mortgage servicing is not a margin game, it's a volume game. So you're making very little amount of money, but if you can build a scalable process and get a ton of loans to service, then you have yourself a business. So a lot of times these mortgage servicing places, I used to visit them, they're in Wilmington, Ohio, for example. That's the place I used to go for work or travel to on occasion, right? Middle of nowhere, not a whole lot going on. Sorry to the folks of Wilmington, Ohio, this is offending you, but it's kind of it because you need to do it on the cheap. And so they don't want to be set up for that credit card processing and have to handle all that. So that's kind of why, probably more than you wanted to know, but there you go. So what can you pay with a credit card if you can't do the, oh, well, let me back up a second. You can, there used to be, if you're familiar with plastic, I have a link to how plastic works down below. It's plastic with a Q. Plastic allows you to pay things with a credit card that you ordinarily can't, because plastic will charge your card and then mail out a check. But what I've seen is in recent times, the payment processors and the banks don't want you to use plastic for paying your mortgage, so it's getting harder and harder to do this. So there's kind of sort of a way, but it's going away very fast. So I'll link to the video of plastic down below. So moving on from that, well, what can you pay for the mortgage process with a credit card? Well, there's a few different things here. So pre-mortgage, let's say you found a house and you're not quite there. You're doing due diligence is what they call it. Like you have a purchase contract, but then you get 10 days before that, okay, good, I want to get a loan for this house and everything. You have a home inspection, the jingle for your protection, get a home inspection. Everyone should get a home inspection. It's not required, but you should get one every single time. Depending on the size of the house, $400 or $500. I mean, they can get into the thousands of dollars if you're buying like, a mansion or something out in the country where they have to check well and septic or anything like that. So that, you'll just pay the inspector with a credit card. Now, once you're into the mortgage process yourself, there's not a whole lot. There's going to be a home appraisal. The bank does appraisal to see how much the home is worth. More often than not, the bank or the appraisal company will send you a link. Just pay for it with your credit card, and there you go. $400 or $500 again, it changes depending on the type of property and the size and the cost of the home. They can get up to $1,000, but $400 to $700 is probably your sweet spot for an appraisal, especially for like a single family, detached home. And then you might need a follow-up appraisal if something's not quite right. They're neither, something's not up to code, what have you. The appraiser might have to come back. That would be another charge. It's called like a final inspection. It's like maybe $100, $125, $150, something like that. You're not rooting for this though. You don't want this to happen because it's going to jam up everything. It's not worth it. So there's that. Now the real benefit comes into after closing, right? So there's something called your mortgage payment is consisted of a few different things, right? So it's principal, interest, taxes, and insurance, right? Those are the four components of your mortgage payment. So if you were to put 20% down into a property, you get the option to escrow or to not escrow. So what escrow means is the bank or the mortgage servicer is going to collect your property taxes and your homeowner's insurance. It'll just be divided up over 12 months, and then you'll pay a little bit then that mortgage company will make the payment for you when those things come due. If you have less than 20% equity in the house, escrowing is going to be required. If you have 20% or more equity in the house, then you can choose to not escrow, which means you would then be able to pay your homeowner's insurance every year with a credit card. Property taxes, a little bit trickier. It really depends on your municipality. I've had folks here tell me that their municipalities, their local county, takes Google Pay or Apple Wallet or something, and some just say, no, you got to mail us a check. So you want to check that first. Now, you do have to remember that that's going to require you to budget for that for the year, right? Well, property taxes are usually twice a year, spring and fall, and then homeowners is going to be like once a year. So you're just going to have to budget for that. And then there's also, I don't know if it's really worth personally putting 20% down if I don't have to just for that. If you want to put 20% down because it helps you avoid something called mortgage insurance, which is another cost a lender puts on you, basically saying, hey, you have to insure us in case you default. We have to pay for it. So nice of us, I know. If you have 20% down, you do not have to pay mortgage. So there's some savings there as well, plus 20% make your payment a little bit lower. We could go on and on about this, but you kind of get the point, right? Figure out if it's for you or not, but I wouldn't do it either way solely for the option to have a credit card payment at the end of the year. It's probably not worth that. So there you go. That's pretty much the mortgage process there and what you can and can't pay for. Now let's talk about some best practices. So another question you get a lot is, can I use my credit card during the mortgage process? So I'm going to say I personally use mine. The only difference is I do not let any statement, I don't let it close with a balance. So, you have your billing cycle, right? So if I make a payment or I buy something on the credit card, I will pay it off usually when it posts. As soon as it posts, I'll just pay it off. Because if the billing cycle doesn't end with you owing any money, then there's going to be no new balance reported to the credit agencies, right? so you're not going to mess anything up. Now, I would kind of rein it in. Like, I don't go crazy using all my cards, and so I usually keep it to 1 or 2 just so it's less to keep track of. Now, well, how would the bank know? Well, the bank, of course, they're going to pull credit in the beginning of the process. You pay for that, of course. It's like a tri-merge. Means it's usually a tri-merge, which means they pull from all 3 bureaus. You get a full picture of your credit, which makes sense when you're talking about the amount of money we're lending. But they also put credit monitoring on you for the full loan process. But don't worry, because you're nice enough to pay for it. You know, they make you do it. You have to pay for it. It'll be a line item at the end of closing you pay for. So if something does fluctuate, if the thing posts to it your credit, then they're going to know about it. Now, again, I mean, we're talking about a few $100s here, something like that post. It's not going to be the end of the world, but why chance it? Because back to our original point, you don't really know how borderline you are, if you're up one, down one, that whole thing. So the same thing goes with applying for new credit cards. Generally speaking, personally, this isn't like scientific based. I would say 4 to 6 months out, if you know you're going to go through the mortgage process, you probably want to shut down all new applications. Hard pulls on your credit for credit cards aren't the worst thing in the world. It will ding you a few points, but it's nothing to really worry about. But again, when you're talking about mortgage process and something for 15 or 30 years, why not just try to put yourself in the best situation that you can? I think 6 months, 4 to 6 months is fair. And of course, during the mortgage process, I would say no new applications at all until you close. So, you can get your approval letter and go shopping for a house. When I looked for my last one, it took me 5 months to find it. That means 5 months of no new applications. The good news, though, is this can be great if you're gardening and trying to get under Chase 524. This is actually how I got under Chase 524. I bought 2 houses very close together, a year apart, and the looking time and everything, it got me under 524. So there's your silver lining for that. If you're worried about that, there is a bright spot. So anyways, the last thing I would say on credit cards, again, is going into the mortgage, as we said, 4 to 6 months out, no new applications, but probably a month and a half out, you want to actually pay everything down to 0. And the reason being is because if obviously not to carry a balance or anything, but even if you're just paying monthly like you're supposed to, paying in full, it takes a while for the specific issuer to report that to the agency. So, if you put a month in between having zeros reported to all the agencies, that means by the time the bank pulls your credit report, it'll also show zeros and you don't owe anything. If you were to pay off your balance today or even last week, go in and have the bank pull, it'll probably still show that you have a balance, and even though you don't, you can show them your app and everything. It doesn't matter. They have to go off the documentation that they received. So that's just kind of a best practice. Even if you are paying everything off like I know you are, just speed it up a little bit, kind of prepare yourself, so when you go in, it's all zeros. And the reason you want to do that is because the amount of purchase power you get, obviously it's based off credit, but there's also debt to income in there as well. So what they look at is, how much money you're bringing in versus how much has to go out to liabilities. So things like that, if there's a car payment or a credit card statement, whatever, even if it's only like a few dollars, technically that's going to play into their calculations somehow. So if you go into it with straight zeros, that should, in theory, help your debt to income. Obviously, if you owe a ton of money, you're just going to want to wait, get that in order, and then do this process a little bit. But even a little bit, I would go in with all zeros. I'll leave you with this. One mortgage company branch I visited, they had a sign on their underwriting room, and it said, you blew a clear to close, which is like, hey, everything's good to go. We can close and you can close the loan. And it said, you blew a clear to close because you opened a Kohl's charge card to save 20% on a $20 purchase or something to that effect. You don't want to be that person. But anyways, guys, if you like this one, drop me a thumbs up down below. If you found it particularly interesting, then consider subscribing to the channel. Again, posting content just like this every Monday, Wednesday, and Friday. Of course, we're right back here every Sunday with all the news you can use in the week that was in credit and finance. My question for you guys is, let me know what are some of your credit card best practices when it comes to mortgages. How do you balance getting rewards, plus the best rate possible? Or what are some success stories out there? What have you done that made it pretty easy for you to do this and just, maybe get under Chase 524? Love to hear your thoughts about that. But anyways, guys, that's going to do it for this one. As always, thank you so much for watching. I'll talk to you in the next one.